Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitri Pargamonic. And I see I don't have the right screen up. Here's the disclaimer, D. Sorry about that.
All right. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. That's the disclaimer.
Excellent.
I'm going to share my screen. If you guys have any questions, please put those questions on the live chat on YouTube. We also provide a link to Zoom if you want to come on the show and ask your question live. When you click on that link, it takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. It'll prompt you to turn on your video camera. You don't have to turn on your video. Once we let you in, everybody could hear you. You could ask your question direct. While we're waiting for questions to come in, I will start out with the pre-market report, see what's going on in the pre-market hours. Maybe then I'll move over to SPY, kind of continue looking at different option strategy setups. So maybe we'll do that today. Okay, well,
perfect.
Yep. So this is a pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, most actives, our biggest percentage gainers, and our biggest percentage decliners in the pre-market. We see here 148 stocks made our percentage gainers list, 47 on the percentage decliners. From this perspective, we're looking like a more bullish bias at the open. I'm going to filter this list down to only S&P 500 stocks. So we want to take out ETFs, closed-end funds, leverage products, all those we're going to remove just to focus on S&P 500 companies. And to do that, I'm going to use the filters up here, and I'm going to drop this filter down in ETF. When you do that, you have a list of ETFs to choose from. Let's take SPY, that's S&P 500 ETF. I'm going to click on that, and now we have the list below that's filtered out by stocks that are holdings in the SPY, which are the S&P 500 constituents. Couple here that kind of stick out. Tesla still down a little bit, and if you read the news with the Twitter, so far right now he took Twitter over. It hasn't even been that long, couple weeks, but he, what is Elon saying, that he might actually have to take it into bankruptcy in a year if things don't turn around and they don't make more money. So that he's having difficulty right off the bat with Twitter.
Yeah, well, I guess they're losing 4 million a day, and most of the advertisers have stepped away, the large ones.
Advertisers have stepped away. He bought it right into already a big downturn in that space, and he got stuck with it because he really, the unlucky part was he kind of bought it right before kind of like the bottom filled out in digital ad space. We saw what happened to Meta and social media, Google.
And the people you think are the smartest in the room can make the same mistakes as everyone else, right? I mean, Meta invested, I don't know, was it $300 billion in stock purchases above $300?
Right.
I mean, you look at what's going on in the crypto space and FTX. Some of the smartest venture capitalists were buying, investing in FTX going into this market sell-off. And it turns out that, the poster child for the greatness of cryptocurrency was actually, long cryptos in a sense as well, like fully, in trading. And this sell-off has, basically wiped him out. And he was using, customer accounts and raised money to pop up his trading arm. I mean, it's really amazing stuff going on, but even the smartest people can get caught at the top. That's for sure.
Smartest people and rich people lose money too, right? That's how the market works. There's no guarantees for anybody here in the market. It doesn't matter if you're the richest person in the world. Doesn't matter if you're, like SBF, who 30 years old was worth $26 billion at his peak. Last week was worth $16 billion. Had the endorsements of,
can I show it real quick what I saw this morning, which I was amazed.
He had endorsements from famous people, smart people, rich people, hedge funds, but he was, I think, completely wiped out at this point.
So I went to the FTX website today, and you scroll down and join some of the world's biggest names who trust FTX, right? Tom Brady was running ads last Super Bowl cycle. Talking about his partnership with FTX. I know they've named arenas.
Right.
It's really a cautionary tale, that's for sure.
Yeah, and that's one of the things when we talk about trade setups and knowing your risk ahead of time and knowing your worst case scenario, betting small. That just here's a great example of how quickly it could unravel, and he basically had his entire wealth tied to these firms that had leveraged bets, bailing it. He had to bail out, using money to bail out some of these other firms that he was linked to, and then he had to, I guess he started moving funds between these exchanges and his trading firm, and then it just dropped. It all happened really quickly.
Yeah, right? Well, they were market makers, right? They were market makers in the cryptocurrencies, probably the largest market makers. And actually this morning, it was described as his strategy was picking up pennies in front of a steamroller, which we've used here, right? To describe selling, cheap out of the money puts. It's just really interesting because he comes from a trading background, but he's very young, right? So he hasn't seen, high levels of volatility. I mean, I remember my first Christmas party with Timber Hill, which has become Interactive Brokers, Tom Petterfeet telling us never sell cheap puts. That was like the start of his holiday celebration speech. It's just, he was very comfortable, taking on obviously abnormal amounts of risk, and it blew up in his face.
I think part of trading is, you got to learn from those losses. If you have successes for a long time, you feel like you become invincible and you just start doing things bigger. You just think, I got to be bigger, I got to be. And what happened, I think, was in the beginning, he made a lot of money in an ARB, which is basically, kind of a riskless play, because he was buying coins in one area like US, flying out, selling it in Japan at much higher prices. Kind of, he found an ARB, but that disappeared, so eventually the ARBs disappear. Then you go into riskier, and then you have to leverage your bets. And really, for a long time, low interest rates were helping those coins and yield farming and whatever they were doing. But as interest rates are moving higher and they're competing, and these yield farming strategies don't look as rewarding any longer when you have Fed paying you 4% on the short term, almost, we got almost to almost 5% on the 2-year, 4.8, something like that. People are going to go to the riskless bonds. It becomes much harder to compete with that. So a lot of things went against them, and you become, if you haven't seen failures, you become overconfident.
And
that's when
he did classically the same exact thing you hear about when they talk about Bernie Madoff, right? He then started going after customer funds to prop up his losses.
Well, if he did that, then he's going to be in trouble.
That's literally, I mean, that's what's being said. whether he did it or not has to be proven in, I guess, court. But yeah, that's
Right. If he did that, then he's got bigger problems besides, his wealth destruction, which they say is it's the worst wealth destruction fastest that we've seen in history. He did go, right now they think he went to zero basically. While we're here, let me move on to SPY just so we have a little bit of time to do some trade setups. Yeah, and the headlines are everywhere with them. You open up any kind of financial, it's his firm going out of business basically. Let's take a look in SPY. Big rally yesterday, 5.5%. That's after the CPI numbers came out. Not as bad as it was, prior. I think 7.7. We're above 8. Looks like maybe it's starting to cool down. I don't know if just one CPI is enough. They want to see that CPI continues to trend down and stays down. So we did get one good number so far. Market took that number, rallied yesterday, huge 5.5%. Just to show you guys what a monster rally this is and what kind of volatility we're in right now. I'm going to go take you here to the price action analysis.
And here's the question. Is this another FOMO trade going on?
That's
I mean, because data shows that, if you were able to invest in the start of bear market rallies and the first big moves, that's where a lot of the money's, so is this like fear of people missing out on the start of the next, bull rally? Or is this a bear rip? I mean, who knows?
Yeah, this is the volatilities and as these interest rates, if they climb higher, we're going to see higher volatility. But look at the volatility on the one-day gain in the stock market. In the last 10 years, it only happened 8 times. Okay, 8 times, 0.3% of all the days. There are only 8 times in history that we've seen the market, and that's including yesterday, go up more than 5%. And a lot of those days, here they are. You could see when they happened, all very close. It was during the coronavirus where there's a lot of volatility, right? But March, in the March space, once, in 2018. So that's what we're competing with right here. It's not very common to see such a big increase in the market in one day, over 5% yesterday. So where were we at? I think it was 5.5, I said. But there you have it. That's how rare of a move it is. What we've seen just yesterday, 5.5%, adding another 0.5%, it looks like, in the pre-market. But let's take a look at November, before we think of trade setups. And this is another stat we've been looking at in the beginning of November. November tends to be a positive month. Last 10 years, right, 90% of the time for the month of November, the market finished higher. You could see on average up 2.8%, one of the highest, best months, calendar months. And if we take the median return right in the middle, not even the average, it is the best month. Median return up 2.7% for the month of November historically. So that just tends to be a very good month for the market, right? And December is not so bad either, 70% here. January starts to weaken a little bit, but November, December, pretty good. Applied vols tend to come in. We go into the holidays. People get bonuses. holidays make people feel better. I think more money just pours in. So that's we're at right now. Even with yesterday's rally, we're up 2.2%. So right near that, still below the average, below that median. I'm going to go to the options chain right now. And we started using the options profit calculator to do trade setups. And when we do trade setups, we wanted to create a strategy around some kind of a thesis, right? And the thesis is going to come, you're doing your research, reading, coming up, just like we were looking at stats, and you come up with a thesis and you're like, well, how can I set up a good risk reward strategy? And just based on what we kind of saw today, November, December seems to be strong months. We did take a look at the implied vol seasonality as well before, and the implied volatility in November, December, you could see starts to decrease, kind of stay there below the average, starts to increase later on. But these 2 months tended to be positive. Implied volatility comes in. We got some holidays in there, so less days trading going on. People are busy. We already had November. That's already gone. The Fed, increased rates. The next one's in December. So the beginning of the thesis might be, all right, for November, December, the market might be okay, right? The market might be okay based on, historicals, based on right now, we got a pretty good CPI number. Markets are feeling a little bit confident here. So let's start out with that thesis. And then we still have another interest rate hike in December, potentially, right? So far, that's not off the table. It might be a 0.5 point, but maybe even a quarter, but that's not off the table. And we still didn't feel the full effects of the previous interest rate hikes. So those effects we're still going to feel in the future. We still got some other things going on with oil and energy that we could see spikes, and volatility tends to start increasing after this. So let's start with up to December. We think we're okay. And then after that, that's where we want to maybe own volatility and some downside. Okay. So the thesis is up to December, we're okay. Markets should be fine. But after that, come January, February, March, we want to be ready for potential increase in volatility and maybe some downturn or some downside risks. Now let's go to the options chain and see if we could set up a strategy that looks like a good risk reward, given that thesis. I'm going to start out in December, right up to New Year, December 30th. Okay. And if we think we're okay, and there is no one strategy. I'm just keep in mind, we could sit here and create many different strategies, even with that thesis alone. But I'm just going to start one as a demonstration to get us going. All right. And then you guys could, use that as a basis to move it around based on your own outlook. But let's say that, on average, if we take SPY and we think, hey, you know what? On average, it moves, what do we say, 2.8%? Maybe it already did that. We're close to there right now. And let's say that, the median return, I think, was 2.8%, something like that. We're almost there, 2.2. Maybe we even have a little bit of upside, but I'm going to give myself some cushion. And let's just say I'm going to go down maybe to 3.9, down one. If I go down 1.1%, that would mean if the market goes down to 390, that would imply for the month of November, we're up 1%, right? If I deduct that. So let's just start there. I'm going to sell that
Hey, D,
put. Yeah.
Rob is asking, why isn't a big upside indicated as volatile, or is it?
I'm not sure what that means.
Rob, maybe you want to expand on your question.
Yeah, it is volatile. A big upside. Volatility.
I'm reading it, and I don't know if this is the case, that usually vol comes in when, whether stocks or the market goes up. So maybe that's what he's asking.
Yeah, I'm not sure. What he's asking, but the move is volatility is the actual percent, right? It's the move. It's the percentage move. It could be up or down. Volatility is the magnitude of the move, right? It's not a direction, it's the magnitude of the move. And this 5.5% is a really big move, right? Look, that's a big move. We just looked back in history to see how rare that move is. So it is a volatile move. But let's get back down to the thesis. Maybe I didn't understand the question, if you could follow up. So I'm going to start there with the assumption, well, I think we're going to end up, as my starting point above 390 for the month of November. I'm sorry, even for December, right? This is December 30th. So I'm giving it down 1.1% from here. Okay. We're going to be above that by December, ending December 30th, because the market tends to be stronger. We had a big move, and it'll hold on to that. So 390, right? Strike. I'm selling that put for 1106, right? And really now I'm interested to own puts that are further out, because that's where, I'm going to make an assumption where we start seeing an increase in volatility. And after the New Year's, we're going to see some more movement. We're going to see first quarter earnings that may not come in good. We're going to see more effects from the previous interest rate hikes. Energy prices might start going up because we got sanctions coming in December that we don't have now. Strategic reserves are dwindling, that we're selling, a million shares a day. All that, we're going to start seeing issues later on. So let's go out to, let me use end of March, right? So I brought in $11 selling that put. And let's take a look at which puts we could buy, because now we're really interested in the downside, right? So in the downside, I'm going to go over here. I'm going to pick, maybe the 330, right? The really downside puts here, where if my fear is that we're going to go below the lows that we've seen. All right, that's the thesis right now. We're going to go below the lows that we've seen. So let's take the 330, right? 330 line, I'm buying that put. So now I'm doing a diagonal, right? Buying the selling the December 30, 390 put, and I'm buying the put in March, the one that's already out of the money, way out of the money. And just in case we punch through, I'm going to buy an extra put, right? Because right here, I brought in 11, buying something for 520. I'm going to go down even a little bit more, and I want to own some Vega. And maybe we really punch through, so I'm going to buy another one at 305. Okay. So what did I do? I did a diagonal spread, and I did and I didn't do a ratio. I did 2 puts and 2 separate strikes. So sometimes we do ratios, right? Buy 2 of these, you could do that. Buy 2 of these, sell 1 of these, or we buy on 1 strike and then strike lower. And let's see how that one looks right now. And this is what it would look like on December 30th expiration. On December 30th expiration, this 390 put will be either in the money or out of the money. Okay. What we have left over is those March puts, right? And the March puts will have some time premium left because it's not over for them. It will be over for this put December 30th. It's going to expire March 31st. Those puts still have time premium left because they still have ways to go for expiration. And we don't know what the implied volatility will be exactly for those puts on December 30th. We have to make an assumption. And based on that assumption, we could run a profit calculator along different strike prices. The initial assumption is that the implied vols are going to be the same as they are today, right? And we could change those around. But if they are, this is what it looks like. So you could see here, right? If we go up, if we go up December, keep in mind, this is December 30th. If we're up and you were around here and you were around here, then basically this will be profitable because we brought in more money, right? We brought in a credit. So for that strategy, we actually brought in a credit. So if those puts expire worthless, these puts expire worthless on December 30th, then we got these two puts for free. Basically, now we're just sitting on puts that either we could sell out or we could hold on to them till March 31st. But at that point, then those puts are basically sitting on our books. They're sitting in our portfolio. But on December 30th, if these puts expire worthless, these two are going to be free to you. What if the market does fall? And let's say December 30th, the market falls, and you could see it sliding down. So here we got some risk here, right? We brought in 287, but we could, here we stand to make maybe 700 to lose 3,000, but maybe not so fast. That's assuming implied volatility doesn't go up. If the market's going down this severely, we should expect implied vols to increase. So I'm going to increase those implied vols, and I'm going to take it up, I think, by 20%. So 1, 2, 3, that would be 10%. 1, 2, 3, 20%. Let's read. Right. So I'm going to redo that strategy. So now if the implied vols are here, you could see the curve is not as bad. Up here, obviously, it'll still be a win. Down here, about 2,000. What if it really goes down? That's around 5%. It starts to climb back up here. So the idea is, we are expecting it here, the market not to do anything between now and December. It's not going to crash out. But after December, if that's what we're worried about, then this is a potential trade setup where, we could own those two puts and try to finance them with those December. Okay, let me see if I go out 3 standard deviations here. So that's where then it starts to climb up because you own those two puts. We're running out of time, but if we started this as a basis, now I could even move those strikes around, or I could change the ratios around to see if that fits better. So here, what if I let go of this 305 and I buy 2 of these? Oops, sorry. I'm going to change the ratio to 2 of these. How does that look? So here it is. So that kind of looks like this. Maybe similar. Maybe not as much down. So we're already over 930. but wanted to kind of just show you guys, different ways to use the options profit calculator. If you have a thesis, and based on that thesis, start to work around the options to see where you could create a profit and loss around those, around that outlook.
Awesome job, D.
All right.
Remember,
Everyone,
we're actually on Friday of this coming Monday, and next
Monday.
Friday, we're not going to have shows due to personal events in each of our lives. But everyone have a great weekend. Awesome job, Dean. See everyone on
Yep.
Tuesday.
thanks everyone. Yep. Keep in mind, Monday morning, we don't have the show. Next Friday, also, we got some personal stuff to take care of in the morning, but we will be Tuesday through Thursday next week.
Awesome. Great job,
All right.
D.
Bye, everyone.
Have a great weekend, everyone, and a great trading day.